Thanks very much, Alec. That was I still remember that walk, and there have been some good and bad times since then, but I think you made the right decision then. And as Frans said this morning, South Africa is actually a place where a lot of people have left, and I'm a result of that. The success I've had in managing money is because my competition is so bad, not because I'm so good. The good ones are all offshore, eh, Sean? Okay, so another thing Frans touched on this morning was the role of mass media globally and in South Africa. And I've been on record as being very critical of the media sector. Basically what's happened is they become sellers of clickbait, trying to force their opinion, their globalist opinion on us regular people, which suits them but doesn't really suit us. And in the process, the media sector has become completely discredited. One of the exceptions, one of the very few exceptions to that is BizNews. And for that, I'd like to congratulate you. BizNews is a platform that allows different points of views to be heard and allows us as the members of that community to make up our own minds. So for me, I would like to say thank you for providing me with this platform, Alec, and also it's an honor to have spoken, I think this is the 7th event, at all 7 of them. So thank you very much. Within this hall sits the core of the BizNews community, and I think if you look around, you'll find a lot of people you don't agree with. You'll have different points of views on different things. But the one thing all of us in this room can agree on is that we are looking for that Lollapalooza investment. The one that knocks your socks off. A 10-bagger in no time at all. A ridiculously good investment. That's what we all want. Charlie Munger defined a Lollapalooza event as a confluence of different factors that come together that result in a huge non-linear outcome. Either positive or negative. Could be either. But that's what a Lollapalooza event is, and that is what we are looking for in investment terms. But these things are scarce, like unicorns. They're hard to find. So how do we find these things? Again, referring to Mr. Munger, he said if you want to solve a problem, one of the ways to do so is to invert. So if we're looking for a ridiculously good investment, maybe we should try and find out what is a ridiculously bad investment and work from there. A ridiculously bad investment is something that destroys large portions of your portfolio, takes it to zero, and makes it hard to recover, a permanent loss of capital. That's a ridiculously bad investment. To find out how these work, let's start that journey of finding out at the common or garden variety bad investment, the one we all make all the time, the ones we don't even want to admit to ourselves. They're all over our portfolios. But the main characteristic of a common or garden variety lousy or bad investment is that they don't destroy your portfolio. There's a bit of a setback, but you can carry on. An example, and the reason you can do that is because when you make the investment, you recognize the risk and you apply basic risk management tools, either through a position sizing, which is appropriate, or a price to value relationship, which is appropriate, or a combination of those two things. That is risk management. So when the risk event happens, it doesn't destroy your portfolio. A bit of a setback, but doesn't destroy your portfolio. An example is something like the Argentinian century bonds. Argentina issued 100-year bonds 6 or 7 years ago. Now, Argentina is a country that has defaulted many, many times in the past and will default again over the next 100 years. In fact, 3 years after they issued these bonds, they did default. But people knew the risks of investing in Argentinian bonds, so they priced the bonds accordingly, and it wasn't a widespread investment in everybody's portfolios. So when they did default, these bonds declined by 40%, and no one really got hurt in the process. That's your common or garden variety bad investment. A ridiculously bad investment, on the other hand, is one that destroys your portfolio. They inflict mortal wounds on it. For this to have happened, there must have been widespread acceptance that actually the prospects of this investment is good. That's why it isn't commonly held. People would have been looking at the Emperor's New Clothes saying, I want some of those sexy threads today, immediately. And I don't care what price I pay to get that designer kit. That's how it starts out. In my investment lifetime, I've only encountered a few such. Now, I'm going to give you some examples so you can see what a ridiculously bad investment looks like and what the process is. The first one is one before I started investing. I'm old, not that old. In the late 60s, and I think Howard Marks talks about it in one of his memos called Sea Change. Talks about the Nifty 50 stocks. These were the 50 American stocks which everybody had to have. They were busy changing the world. They were technology stocks, busy changing the world, and no price was too high to pay for these stocks. The Nifty 50. If you had bought these stocks in 1969, well before they peaked, they only peaked in 1972, I think, 3 years later. By 5 years later, by 1974, you would have lost 90% of your money. So a bunch of widely held stocks, dominating portfolios, lost 90% of the value. That is a ridiculously bad investment. How about the whole TMT bubble and boom when we spoke in Australia? That was going on at the moment, at that time. The internet was busy happening. Everybody's saying the internet is going to change our lives. There are companies that are building the infrastructure that will carry the internet, and there are companies selling them their picks and shovels that will help them build this infrastructure. No price is too high to pay for the shares of Cisco and Dimension Data and the telephone companies, because there will be growth as far as the eye could see. And there's a direct quote from John Chambers, the CEO of Cisco. Growth as far as the eye can see, forever. These stocks were widely held in most portfolios. Yet, even today, Cisco's share price is lower than it was in 2001, 23 years later. The telecom companies are less than half what they were then. Dimension Data went down 90% and was acquired by a Japanese telecom company, and that joke writes itself. These turned out to be ridiculously bad investments. And then there's one closer to home, one I think we're all familiar with, Steinhoff. Steinhoff was a company that listed in 1998 to lukewarm reception, but then it appointed a CEO by the name of Marcus Uester, who had a reputation as a brilliant financial engineer. And he went on to put a package of offshore retail businesses together that it was like catnip to South African investors. They cannot resist the lure of somebody building an offshore empire. They need to fund that. It turned out eventually that this brilliant financial engineering was actually not really that brilliant. And as we all know, Steinhoff went to zero, and a lot of very brilliant business people had large chunks of their wealth invested in it. Institutional investors were falling over themselves to be more overweight than the other one in Steinhoff, and regarded those who did not own Steinhoff or were underweight Steinhoff as dumb. I know, I was one of them. But Steinhoff turned out to be a ridiculously bad investment. So we can see ridiculously bad investments have one thing in common. They are widely expected at the outset to be good investments. And as such, the basic tenets of risk management are suspended, and people and portfolios acquire outsized positions in these otherwise risky stocks. So if we invert once more, the place to find a ridiculously good investment is one that looks like, at the outset, like a ridiculously bad investment. One that is underowned, regarded as probably guaranteed to fail, and pretty cheap. let's look at a couple of examples of ridiculously good investments. Naspers in 1998 was a stock traded over the counter, and it basically was a newspaper publishing business. Fuddy-duddy business. Nobody really cared about it. Nobody owned it because it was over the counter. We don't buy over the counter stocks. They're far too risky. But it was a business that generated a lot of cash, and management used this cash to buy a whole bunch of technology and technology-oriented businesses, most of which failed, exacerbating the market's view on this business. But one of them was a company called Tencent. And the rest is history. Naspers turned into a ridiculously good investment. Microsoft in 2012 was regarded as a purveyor of old-school software. Its CEO was an out-of-touch boomer called Steve Ballmer, whose brilliant insight was to buy a bankrupt telecoms company called Nokia. People did not care about Microsoft. They thought it was history. Yet along came Satya Nadella, the cloud, AI, and since 2012, Microsoft is a 20-bagger. But nobody owned it 10 years ago. Well, how about Nvidia? In 2012, Nvidia was a manufacturer of GPUs, general processing units, for the gaming market, the PC gaming market. In 2012 to 2014, PC sales were flat, and the gaming business was going sideways. And in fact, Nvidia had already started developing chips for machine learning and artificial intelligence at that time, but nobody cared about that sort of thing. It had, in fact, just developed the NV1 GPU, which turned out to be a dud and nearly bankrupted the company. Nvidia was nearly bankrupt in 2012. Very few people know this. But again, along comes machine learning, AI, and all sorts of other events, confluence events, and it has turned into a ridiculously good investment. So the common thread here is, at the outset, these were not regarded as popular or widely held investments. Quite the opposite, in fact. So the point I want to make here is that Lollapalooza outcomes only happen when they are regarded as the opposite. That's where you need to look. So currently I can think of a few such examples. I mean, we talk about the climate crisis and net zero and all these wonderful green things, and we don't really know what they mean. But the media has imprinted this crisis into us to such an extent that we buy into the whole net zero theory. But anyone who has read Václav Smil's book, How the World Really Works, will know that we will be using carbon-based fuels or any source of energy for a very long time to come. But because we've bought into this net zero way of thinking, nobody wants to invest in energy businesses, carbon-based energy businesses, oil and gas. So that's one type of example. GMO, Grant and Meyer van Otterloo, the New York-based, value-based investment company. There are very few of these left, but they are one of them. They, according to their metrics, deep value is one of the cheapest situations in the world right now. And they define deep value as stocks that are trading at a big discount to intrinsic value, but they don't include cyclical stocks or what they call value traps, the classic cigar butt, the one puff and you're done type of stock. They look at good businesses that are trading at a discount to their intrinsic value or fair value, and they say that cohort of assets relative to the market is the cheapest it has ever been. But nobody owns value stocks, and they certainly don't own deep value stocks. South African equities, or small and mid-cap equities, is another special case of this deep value quality cohort of stocks. No one owns them. South African mid and small cap stocks have been subject to consistent selling pressure over the past decade as South African investors have moved their money offshore, withdrawing from local funds, forcing the fund managers to sell what they have, and what they have are those stocks, and then buying Nvidia on the other side of the Atlantic Ocean. South Africa is a corrupt, bankrupt country run by communists, guaranteed to fail. The rule of law no longer holds. Why would you invest in its equities? That's the thinking. Any one of these above three mentioned assets, I think, can turn out to be a Lollapalooza outcome, a ridiculously good investment. Now, I'm often asked, so the American stocks have done so well for so long, the African stocks have done so badly for so long, what could change this? So let's take a step back and look at the dynamics of how the market is put together at this point in time. The USA is 26% of global GDP. Yet, US stocks make up 63% of the MSCI All-Country World Index. I don't think it's a stretch to say that US stocks are possibly overrepresented in a broad index you might buy today. On top of that, our numbers show that the US dollar is one of the most overvalued currencies in the world. And at some point, that will come home to roost. So investors in a broad index of global stocks have massive exposure to expensive US stocks and an expensive US currency. The BRICS nations make up 28% of global GDP. On a purchasing power parity basis, it's 29%. On a purchasing power basis, about 36%. That's just BRICS. If you add other large emerging markets like Malaysia, Philippines, Thailand, some other South American countries, Eastern European countries, it's closer to 50% of global GDP is made up of emerging economy GDP. Do you want to know what the weight of emerging markets is in the MSCI All-Country World Index? 13%. A huge part of the global economy is not in the index. South Africa is 3% of the emerging markets combination. So in global terms, we're about 0.3%. Global investors have a functional equivalent of zero exposure to South Africa at this point in time. Let's have a look at South African investors. Well, they've been doing three things over the past 10 years. First of all, they have been running offshore, taking all their assets offshore as quickly as they can. Because we are a corrupt country run by communists, guaranteed to fail, we have no electricity, and so on and so forth. Fear sells. It's been easy for advisors to tell you to take your money offshore because it makes logical sense. But I think we've seen this morning already that things are changing. In any case, so that's one thing South African investors have been doing. They've been taking their money offshore. Number two, they've been indexing, which is a rational strategy. There's nothing wrong with indexing. The only problem in South Africa is that the index consists of a hodgepodge of randomly selected companies that happen to be listed in South Africa, offshore companies that happen to be listed in South Africa. Companies like BHP Billiton, Glencore, British American Tobacco, Richemont, and so on and so forth. These companies which dominate the South African index have no exposure to South Africa. So to the extent you buy the offshore index, you are taking your money offshore. And the third thing that South African investors have been doing is they've been risk managed by the consultants, the risk managers, the asset consultants, and the DFMs into the large funds of Coronation, 91, Allan Gray. Now, if the offshore index is vanilla, these three big managers are Essence of Vanilla, Vanilla Crunch, or Vanilla Flake. It's all vanilla. They have no choice. They are so big, they have to buy the index. And when you buy the index, you end up with a hodgepodge of randomly selected offshore stocks. I would argue today, South African investors in the aggregate have the functional equivalent of zero exposure to South African stocks. Today, it's not hard to put together a portfolio of small and mid-cap South African companies on an average PE of 6, with a dividend yield of almost 7%. And these are not bad companies, they're not cigar butts. The average return on equity of such a portfolio is in the region of 15 to 20%. Good to above average businesses. And you can buy them at a price to book of less than 1. South African stocks are under-owned and they are cheap. What did we say about ridiculously good investments? What do they look like at the start? They look like ridiculously bad investments. I think the table is set for a Lollapalooza outcome here. I do have some bad news. The bad news is today is not the best time to buy those stocks. It's a good time, but it's not the best time. The best time was 2 to 3 years ago, when we were all so pessimistic and negative about what was happening in the country. And I'm not being facetious when I say this. One of the BizNews community members put real money into the Merchant West Investments Value Fund, which I manage, and into a selection of offshore funds that a financial advisor proposed at that time. This is almost 3 years ago. The outcome from that date, and this is real money, these aren't made up numbers that I hope are right. Real money. At the end of July, the Merchant West Investment Value Fund was up 22% in rand terms, and the offshore selection of assets was down 3% in rand terms. Just because you believe the media and their stories, and you don't want to listen to Frans and Teto's stories, doesn't mean that South Africa has to be a bad investment. In fact, I think this party has just started. Thank you.
Yeah, well, you know the drill. Given that Piet, where Tony has been to all of the conferences, Piet has spoken at all of the conferences, and I think you know why. But it's the Piet versus Magnus show, and we've got Magnus coming later, and even Magnus, is Magnus here? Magnus? Yeah. He's one of the... Was Magnus? Is hy nie hier nie? Hy kom later. Okay. But it really was R1 million that the member of the community said, let's just fix this thing once and for all. Piet, there's R500,000. Magnus, there's R500,000. And certainly you went into the lead from the beginning, and you've been smoking ever since. But it has only served. Okay, well, just press it a little lower. There we go.
Yeah, and by what I forgot to mention, the Merchant West Investments Value Fund only invests in South African companies. There are no offshore companies in it.
So that means none of those BHP Billetons, Richemonts, etc., that have got that in. That's
mainly mid and small cap companies.
Okay. So if you want to follow what the Lollapalooza argument, and where does it come from, that word Lollapalooza?
Charlie Munger coined it in one of his commencement addresses to some university. I think that's where he first mentioned it. It was his construct, Lollapalooza.
It's been quite widely used since then for this sensational...
It's a great word.
Yeah, fantastic. But so the Lollapalooza opportunity here for people was put your money into the Merchant West Value Fund, the fund that you at RCM manage for them, or go and buy the individual stocks that are in there.
Yeah, you can do that. Look, I mean, I would prefer that you buy the value fund. Because the danger, again, I don't want to come across facetious. The danger is you pick this stock and you don't pick that stock. Or you pick these 5 and not those 3. And then it turns out those 3 are actually the good ones and those 5 aren't. Whereas the value fund now holds all 8, because I don't know which are going to be the good ones and which are going to be the bad ones. And I think I've said this before, is that if I knew which would be the good ones with any degree of certainty, I would only buy those and not the other ones, but I don't know. You buy a selection, you buy a portfolio of assets to give you the diversification against something going wrong with any specific company. So it's always nice to talk about specific stocks, But it's something I try and avoid doing because with any business, no matter how good, something can go wrong. So if you just pick one of the stocks held by the value fund, I think you're exposing yourself to significant single stock risk. And that's why, without being facetious, I think the value, if you want exposure to South African businesses, the value fund is the thing to do.
And we have a real life example of that.
Yeah.
At one of the events, you were very bullish on the company that owned We Buy Cars, because
that's right, yeah.
you
Transaction capital.
You thought that We Buy Cars was a great asset, and so we went and put transaction capital on the strength of that into our portfolio, not knowing that Piet or forgetting that Piet is an active manager. So you'll track it all the way through, and when things turned as you noticed, maybe tell us that story.
Yeah, well, I think you're attributing skills of premonition to me. What happened was when I think it was at the very first BNC 1 that I spoke about it, and that was just after COVID, and all businesses went through tough times, and We Buy Cars or Transaction Capital was one of them, and it was priced at 25 to 30 Rand a share, which at that time was reasonable, but subsequent to that, it went up to 50 to 60 Rand a share. And I just thought it got expensive and wasn't discounting or wasn't paying you for the risk of something going wrong. I didn't know if something would go wrong. I just said the risk reward is out of kilter here, and I sold the position at that time. I didn't have any inclination of the management team going down the wrong road. I didn't know that.
But the point is that that's your job. That's your
Exactly,
profession. Yeah. That's what you do every day to make sure that those stocks that might be in your portfolio today might not be in that portfolio tomorrow. You don't actively trade them, but that's really
right. I mean, that is our job, is to monitor the price value relationship and act accordingly.
But when you have a look at South Africa, the general feeling is that things are getting better. The Springboks win, and everyone's terribly optimistic, and it kind of reaffirms. It's strange to see that JSE hasn't gone up after we beat the All Blacks twice. But what do you put that down to? Is this a real thing that we are just now seeing, that things aren't as bad, or in fact have got more promising than we previously thought? Or is it government of national unity?
I think it started with elections and the subsequent formation of the government of national unity. I think that gave a lot of people, most South Africans who are, as has been pointed out many times this morning, moderates, that gave them some confidence that the future wouldn't be dominated by the radical left or the radical right or whoever, that there would be moderates in charge of the show. And I think what's been happening at Eskom has probably been forget about the Springboks All Blacks, that's a sideshow. What's been happening at Eskom is the biggest confidence boost the economy can have. I mean, at the end of the day, energy is life. Energy is growth. If you don't have energy, you can't grow and you can't live. And it's a massive destroyer of confidence. And we lived through that. But it seems like we're on the road to fixing it permanently, and in fact, getting to a situation where we can actually have cheap electricity. We'll hold you to that one. And that would be huge. That would be massive. What has also happened since election is that our long bond yields have come down by almost 300 basis points, 3%. That is a huge reduction in the cost of capital for South African business in general. So any business that was chugging along, generating a certain level of profits, the value of that profit stream is now a lot higher just because interest rates have come down, or the long bond yields come down, which is the risk discount rate you use to discount those cash flows to present value. That's a massive boost to valuations. And I still don't think that's fully even reflected in the market, that boost. So you have this confidence. When I speak to my friends and people I know and clients and that sort of thing, there is a sense of a lift in confidence. And discount rates have come down. So if you can imagine 5 years from now, a period in South Africa where we've had consistent energy supply, possibly relatively affordable energy at that time, coupled with the confidence of the SA entrepreneurial class, we could have pretty decent growth rates in this economy. And if that happens, we get into a virtuous circle. And that's when you get a Lollapalooza effect from an asset that nobody owns because of what? To one where I want in at any price. It's not impossible to imagine such an outcome.
Has it happened before in South Africa?
Yes, it has. It happened, if you cast your mind back to 2001, there was a massive negative environment or mindset in the country as well. But the economy had been managed very well post 1994, post the first elections, and the fruit started bearing in about 2002, 2003, and we had a massive boom period in the country from around 2002-3 to 2008 until the global financial crisis. And that was a great period for the African assets. They were some of the best performing assets in the world at that time. So yes, it has happened before, and it could happen again.
You mentioned the chairman of Eskom and his presentation a bit earlier. My question to you is on the perception about renewable energy. If you were advising the Eskom board, what would you be saying to them about the assets they've got and how they should be managing them, given the Western world's push towards renewables?
Yeah, so I have some strong views on this, and I think it falls in the true-false prism category. South Africa as a country has massive coal reserves. We have massive coal energy generating capacity, a lot of it unused. Those are assets that can put us in a position to generate cheap energy. And to the extent the Western media and the globalist powers want the world to transition to net zero after they've had 100 years of cheap energy and they're okay. I'm okay, Jack. Don't care about you. That's the point of view coming from Europe and America. I think that's wrong. As a developing country, we need to use the assets we have, and that is cheap energy, potentially cheap energy, to get to a higher growth rate. And once we get there to a higher growth rate and then ultimately a higher standard of living for all the citizens of the country, then we can start talking about this net zero thing and greening and all those sort of things. So that's where I stand on this issue.
But what about the warming of the world? What about the icebergs that are melting?
I think if you look at where carbon fuels are used, dominantly used, South Africa is a speck on that chart. If we all start driving EVs tomorrow powered by a windmill in our backyard, it's not going to make a difference. It just won't make a difference. China and India are the main users of coal and gas-fired electricity, dominating the world, and Indonesia, Malaysia, all those countries as well. We just don't, it doesn't matter. What America does almost doesn't matter, let alone South Africa. So yes, I think there is a bigger picture here, but I think it's our responsibility as a country to look after our citizens first and then care about what the globalists in the UK think or Europe think.
A little later today, we're going to be hearing from Don Lube, who is the pioneer of gas exploration in South Africa. And there is a listed company in Australia called Kinetico, which incidentally James Lorimer, the DA guy, is the only share he's got in his portfolio. It is disclosed because he was looking at oil and gas, and he can see he's been on our platforms a number of times saying this is as big as the gold boom in Witwatersrand and the diamond boom in Kimberley. Are you, given your views on energy and the future of energy, are you as bullish as he is on the potentials?
Look, I mean, oil and gas people are no different to miners. They say that, a miner is a liar who's standing next to a big hole in the ground. and every miner's big hole in the ground is better than the next big hole in the ground. So I take that with it's possible. I know that on the south coast of South Africa, there's been significant oil and gas finds. It's been disappointing that the companies that own it, Total and so, have walked away from it because of some sort of problem in talking to the government. I'm not sure what that is. It's very disappointing because we have Mosgas that doesn't have gas, and we have gas resources right off the coast there. I think it would be pretty clear to the country what it should be doing there. So if, to the extent there is a big find there, and I think there is, I think we should be utilizing it to the benefit of the country. And if we happen to kill a couple of fish in the process, it's okay.
I've got to just close my part of the questions with Bitcoin. You said to us that Bitcoin should be about 2% of your portfolio. Have an insurance. And we put 2% of the BizNews portfolio into Bitcoin. It's now 6%. So it's done very well. Bitcoin and Bitcoin-related stocks. It was the only two areas stocks we could find. What's your perspective now on Bitcoin? Should we be selling that down to 2% again? Or is it one of those ridiculously bad investments today?
Yeah, so no, I think Bitcoin, cryptocurrency in general, Bitcoin is a specific use case in the cryptocurrency universe. I think there is a place for it. There are use functions for it. I think the thing that Bitcoin has going for it is there's a limited supply of it. And the way that especially Western governments are inflating their money supply, I think there's a good chance that we could have inflation of fiat currencies for a long period of time going forward. And in that environment, something like Bitcoin will be a store of value, which is why I've always advocated having a small exposure to it. I can't remember saying 2%. I said small. 2% is very precise. I think it depends on each person, and each person will have a different risk tolerance and appetite for it. Personally, every month I spend an amount of money equal to a good meal at a good restaurant buying some cryptocurrency. And, whatever happens with it, it's not going to ruin my life if it goes to zero. But if there is an outcome in the future over the next 10 to 20 years, not the next year or two, over the next 10 to 20 years, where fiat currencies that were once regarded as stores of value get debased significantly, I think Bitcoin will be a good risk diversifier in that environment.
I know there are people in this audience as well who really knock my visits to Davos with all the globalists, as you call about it. I go there to learn. And one of the things I learned was in a session with our partners at the Financial Times, Neil Ferguson, the economic historian who's written so many wonderful books, was fielding questions. And he said, if I lived in a currency that was in a country that was turbulent and had a risk towards some kind of social unrest, I would have a huge percentage of my portfolio in Bitcoin, which was interesting because he also referenced what had happened in Ukraine and the people who lived there, and I presume similarly in Israel as well. And I guess working back, 2% is a fair bet for South Africa in that kind of a context.
Yeah, I guess so. I wouldn't argue with that. Yeah.
Bruce Dacres says Bitcoin is up 400% since 2020. Is this not a Lollapalooza investment? And I know Bruce is extremely long on Bitcoin.
And look, it depends on your starting point. If your starting point was a year ago at $60,000 a Bitcoin, then it hasn't become a Lollapalooza investment. But if you bought in 2016, where it was like, I don't know, $100 a Bitcoin, then it has turned out to be a Lollapalooza investment. But, whether it is or not, I don't think is the point. The point is, what role does it play in your portfolio? And I think it can play the role of an anchor of value in a turbulent future.
There's a follow-up question from Jacobus Fourie who says, what digital assets or crypto constitute, quote, a ridiculously bad investment as part of a portfolio in your view by virtue of its mismatch in design intent. Bitcoin's small, easy, cheap payment mechanism, not investment by design, as opposed to the speculative trading perhaps fueling it now.
Yeah, it's a hard question to answer at any particular point in time. I think the speculative activity in cryptocurrency has declined significantly over the past few years. And you can see that in the price action that Bitcoin has been, relative to its own history, pretty stable over the past few years. So I think over time the speculative activity is declining, and the usefulness of it as a hedge and also as a functional, the ability to transfer value from places where you can't use fiat currency, or that places like a place like Zimbabwe, for instance, where the money has no value, but you can transfer Bitcoin across borders to other people and move your money around that way and retain the value of your money in hard currency terms. So the use cases are improving. There's a lot happening in the background, which I don't know that well in terms of the technology and the layering of technology upon these different blockchains. But I think the technology is useful and will increase. The usage of it will increase over time. And the cryptocurrencies which are attached to them, which are the reward for the functions in the blockchain itself, I think that will remain. It's not going to go away.
Our crypto expert, Stafford Marcy, will be here again in March for the March BNC 7. Piet, of course. I hope you don't miss that one. And he is... Stafford's been buying Bitcoin since they were, $5 or something. So he remains a very strong protagonist. And he is probably, I don't know if you'd agree, Piet, but one of the smartest people I've ever met. So he can explain why Bitcoin is such...
He can explain it much better than I can. So, yeah.
Anyway, don't miss March. David Melville, he is going to... No, he hasn't. I thought, David, you were going to ask about gold, but rather... Piet suggested to BizNews Investments that Combined Motor Holdings, CMH, was a good company to buy as it was priced at cheaper than its assets, or as if it was a failed company. He was so right, it's up 30% since he mentioned it at the conference in March. Are there any other companies like this that he can highlight?
Yes, there are. Many.
And?
No, I think CMH is a classic example of and by the way, I think CMH is still undervalued, but there are a number of companies on the JSE which are trading at ridiculously low valuations because nobody owns them and nobody wants to own them. I'm trying to think of Sabvest, one of my favorite stocks as well, Sabvest Capital, run by Chris Seabrook. He has compounded net asset. It's an investment holding company, so net asset value per share is what you want to look at to judge whether he is doing a good job for you or not. So Chris Seabrook has compounded net asset value per share of that business by over 20% for 20 years. I mean, that is a track record that very, very few people can even hope to get close to. Yet it's trading at almost a 40% discount to his net asset value. So I think if you buy that share, and on the assumption that Chris hasn't become dumb overnight, that he's still the same person, I think if you buy that share at the current 40% discount, without even hoping that the discount closes, you're going to earn a return of, say, 20% on your investment over time. And the discount, and as the discount closes because it becomes more popular or people decide to invest in South Africa or whatever, you can earn a lot more than 20%. And I think compounding your capital at rates of above 20%, that's pretty good. Doesn't matter what currency you're doing. So that's another example. But again, something might go wrong in Sabvest tomorrow, and I'd look pretty foolish. And that's always a risk with talking about one stock, because there is risk out there, even for companies like Nvidia. You won't believe it, but even for companies like Nvidia, there is a risk.
Chris Seabrook, by the way, has just bought a big house in Hermanus. Good investment.
He's a good investor.
There was a question here about Nvidia from Ross Wilson. You mentioned it as a ridiculously good investment, obviously in 2012, But at the moment, it seems everyone wants to get in at any price. Could it not turn into a ridiculously bad investment?
I think it could. Its profit margin of 80% is just so high that I'd be surprised if other cash flush big tech companies don't go for its market. I mean, why would they not? It'll take a while to get the design right and to get the manufacturing right and so on and so forth. But I think companies like Apple and Microsoft will eventually go for that market. It is such a profitable and large market and growing market. So I think they're definitely going to face competition. And then the one risk that nobody talks about, and this is basically for all chip companies, whether it's NVIDIA or not, is there is a single point of failure in Taiwan Semiconductor, who are the manufacturer of all these chips. So NVIDIA designs the chips, sends the design to Taiwan, and TSMC manufactures these chips. And that one company manufactures, I don't know what the percentage of, 60 to 70% of all chips, including basically all of NVIDIA's. If something were to happen there, NVIDIA would not have a chip to sell. I'm not saying something will happen. I'm just saying any situation where there's a single point of failure, I think is a far more risky situation than you think it is without contemplating that fact.
That's really interesting. With Intel investing heavily in building chip factories in America and presumably getting, well, they've already got $10 billion of support from the Democrats. If Trump were to come in, maybe he'd give them double that amount and then let TSMC go or let Taiwan go.
Yeah, I do think one shouldn't underestimate the body of knowledge that TSMC has been able to build up over the years in efficient manufacturing, and it'll take Intel and others a long time to match that. And the sort of chips that NVIDIA are designing need cutting-edge technology to manufacture, and TSMC is basically the only business that can do this. And to catch up will take a long time.
Yeah. David Melville, of course, is coming back with a gold question. At the last BizNews conference, Piet told us of his huge exposure to physical gold as well as gold mining shares. He's done very well for investors. Will he look to take profits now that gold is at an all-time high, or does he see more upside potential?
Okay, I think I need to just take a step back. The gold exposure is not in the value fund, to say. I don't like gold investing in mining businesses, generally speaking. So the value fund doesn't own very many mining businesses. I think we have a small portion in Anglo Gold. Where I do have a significant exposure to gold is in a different portfolio, the Merchant West Worldwide Flexible Fund, which I call the cockroach. And I call it the cockroach because it's a fund that is designed to protect your wealth. In other words, you go run your business, you do whatever you do, you make your money, and if you want to protect your wealth, you put in the cockroach fund, because the cockroach is something that can withstand almost anything. Now, in the cockroach fund, the Worldwide Flexible Fund, I have a fixed allocation of 25% to equities, 25% to bonds, 25% to cash, and 25% to commodities, predominantly gold. And this is in global terms, so this fund can invest anywhere in the world. Right now, in the 25% commodity portion of the fund, 14% is in physical gold, 6% is in gold streaming companies, not mining companies, but gold streaming business. A gold streaming business is a business that basically funds mining companies and gets paid by a percentage of their revenue. So they just take something off the top. Like one of the businesses the fund owns is Wheaton Gold. Wheaton Gold has operating margins of almost 70%. It generates, I forget now the revenue. Revenue is a big number, but it has 18 employees. So it's the first derivative of gold. If inflation were to happen on a large scale, a company like Wheaton would be protected because it doesn't have a lot of operating expense. I mean, there's 18 people. It doesn't run a mine. It just takes revenue off the top from the mines it has financed in the past. So because unit trust rules don't allow you to own more than 10% of the fund in physical metal, apparently the rule, it's too risky according to the Association of Unit Trusts. I've had to buy this first derivative of gold mining companies, which is the streaming companies. But again, I don't own any gold mining companies in the fund. It's gold and the first derivative of gold, which is gold streaming businesses.
Chris de Lange's got a really interesting question. How do you see the positive impact of South Africa being delisted or removed from the grey listing playing out, now potentially set for October 2025? I think that came from Treasury yesterday.
Look, I think it'll be another step on our journey of normalization. We've been taking a number of steps over the past year, basically, and that would be another step. I know that the fiscal, financial authorities and regulators are working very hard to get the economy or get the financial system regularized so that it can be taken off the grey list. And I think we'll get there. With the right leadership, it will happen. And that will be just another step forward.
How much of an advantage is it to be thought of as dumb? And I'm using this from the point that you made earlier and the one that Teto spoke about with the Eskom board, that the public perception was, no, you're dumb by not going along with the crowd.
I think it's a major advantage. It's a major competitive advantage. If people think you're dumb, they ignore you, basically, and they leave you to your own devices, and you can carry on and do the right thing. Again, I think that thing that Frans said this morning about the prism through which you view the world, the true or false prism or the consensus prism. In my job of managing money for clients, and generally, I view the world through the true and false prism. And sometimes, or often, that puts you in the camp of dumb people because you're not part of the consensus. And remember, human beings are herd animals. They want to be part of the consensus. They want to go with the flow. So in managing money, it's a huge advantage. It's a huge competitive advantage. The problem with managing money, of course, is there's two aspects. The one is actually managing the money. The other one is getting the money to manage, the assets under management. Now, if you play the consensus game, it's easy to get money under management because people will back you because you're part of the consensus. Let's take all our money offshore. Yes, let's take our money offshore. South Africa is shot. Nothing's going to ever happen. Let's take our money. That's easy. That's easy sell. Everybody takes their money offshore. But 3 years ago, I was standing here saying South Africa actually is good value. It's risky, but it's good value. Nobody wants to back that view at that time. It's just so you have this dichotomy of being dumb, but being right more often than not, or building a big fund management house. And I've preferred to build a niche fund management house.
To see the world as it is rather than perhaps as you want it.
Or as everybody else sees it, yeah.
Derek Matthews says, how much of a disruptor is the BRICS to international markets? It appears to already be significantly disrupting grains in the world.
Yeah, look, I can't comment on the specifics. There's a lot of stuff I don't know very much about. That's one of them. But broadly speaking, the BRICS block of economies, is a very strong block. I mean, in terms of economic power, it is large. In terms of buying power, it is large. It's bigger than the US. But whether the BRICS is a cohesive unit, I doubt it. I don't think it is. But again, I think South Africa, if somebody were to ask me advice, which they won't, but if they were to ask me for my advice, I'd say, as Frans said this morning, you've got to play the game. You can't pick a side here in the world where you're a minnow and all these elephants are trampling the grass and down there. You can't pick a side because you will get trampled by one of the elephants. You've got to play the game and, make friends with everyone or let everyone think you're their friend. And I think that's probably possibly the right strategy. So the BRICS block, I think, is significant. I think it's growing in influence. I don't think you can ignore it. And I think we've been inculcated in South Africa with this mindset of Russia is bad and the US is good. But if you look at the arc of history over the past 30 or 40 years, some of the worst acts of war and genocide have taken place under the US flag. And whether you like it or not, that is a fact. But the media wants us to believe that's good and what Russia is doing is bad. And these things are all bad. I'm not trying to justify anything here. I'm just saying that one has to look at the world as it is and realize that the BRICS bloc is a significant power bloc and its power is increasing. And you have to play the game accordingly.
Last question. I don't know if this is an area that you look at, but Sanjay Daya wants to ask, are there, other than Palantir, are there any South African or are there any AI stocks emerging?
There are many, many AI stocks, but so I don't know. I don't follow the AI stocks. I think the only comparison I can make is that 100 years ago, or just over 100 years ago, there were 500 motor manufacturer companies in the USA. By 1960, there were 3 left. But in 1920, you didn't know which ones would survive. In the year 2000, there were hundreds of internet stocks or internet companies around. Hundreds of guys selling pet foods and books and this, that, and the other. But you wouldn't have known that Amazon would be the big winner. So these things are always easy in hindsight. But at the time, like we're going through an AI boom right now in stocks, and it is a technology that is going to change our lives. But predicting the winners today, I would say, is an impossible task. It's very hard to do that. I'd rather stick with the things where the odds on your side, where the price-to-value relationship is okay, and wait for the day that Nvidia trades on a P of 10 like Microsoft did in 2012. Or Amazon did in the early 2000s. Remember, Amazon declined by 95% from the peak of the TMT bubble. You got a chance to buy these things cheaply. You just have to be patient. And right now is not the time.
Yeah, and to that point, our partners at Exclusive Books, they're not here now, but they will be at the March conference. I asked them to bring a book by James Nairn called Engines That Move Markets. And Engines That Move Markets looked at all of those innovations. And his conclusion, it's a thick book like this, going right back to telegraph and motor vehicles and you name it. His conclusion was it's almost impossible to pick the winners when there is a massive innovation. At the moment, people have picked the winners. The markets or investors or punters or traders or whatever have picked the winners, but they're not necessarily going to be the ones in the future. I think that's what I'm taking from what you just said.
I think that's right. I think if you look at the NVIDIA valuation, the market is saying NVIDIA is a certainty to be the dominant force behind AI. That might be true, but that's what's in the price. So where's your investment return going to come from? Investment returns come from things that are not expected happening, not things that are expected. So I would say there's a lot expected from NVIDIA, and I think you'll struggle to make a good return from these sort of levels going forward, as opposed to South African small and mid caps.
Just one final point there. Koos Becker's strategy in 99, 2000, he and Antoine Roux described it as throw mud at a wall and hope some of it sticks. Can we not be throwing mud at the AI wall today because that stuck with Tencent, and throw mud at the AI wall today and hope that some of it brings another Tencent?
You could, but I don't think that's a strategy that one can replicate easily. They got lucky in buying Tencent. Most of the stuff they threw at the wall didn't stick. And they might have missed Tencent. I mean, normally, if a company has a strategy, you want to be able to replicate it with some expectation of success. Now, I don't think that is a strategy one would want to replicate. I'd rather wait until you get a Microsoft at a 10p. Of course, at that time, nobody's going to want to buy it. If NVIDIA goes to 10p because of some problem with TSMC or competition or this and another, no one will want to buy it, which is why it is going to be at a 10 PE. So that's, that we'll have to work through that whole thing again at that time. But yeah.
And for those who aren't really plugged into the investment lingo, 10 PE means 10 times this year's profits. So you've got to wait 10 years buying it today to get your money back just on the profits, let alone the dividend.
And I think Nvidia today is in a PE ratio of something like 80.
When I started business radio, we used to have a guy called Jack Shapiro. I don't know if there's anybody here who remembers Gypsy Jack, because one day when he was at Wits University, he dressed up as a gypsy, and he was forever known thereafter in the broking community as Gypsy Jack. He worked for Merrill Lynch. And I remember asking him in the boom running up to 1998 and some of the internet stocks that were trading at over 100. And his point of look, I'm not going to live for another 100 years, so I certainly wouldn't be buying that company's shares. And I guess the point about that was another 80 years we have to wait on today's valuations to get there. It's just something to bear in mind. Piet, as always, it's been such a joy talking with you. A privilege.